Good afternoon, everyone, and welcome to today's webinar. My name is Yina Tang, a partner in the Tax Advisory Group at Pitcher Partners Melbourne, and I'll be your host today as we take a bit of a whirlwind tour around some of the recent changes to tax depreciation. By way of background and context, accelerated depreciation rules have been a tried and true mechanism for the government over the last few years in their attempts to stimulate business spending and kickstart the economy. Some of you may recall that not so long ago, the instant asset write-off used to be only available to assets costing less than $1,000 and only if you are a small business with aggregated annual turnover less than 2 mil. How times have changed. Since that time, and beginning with the 2015 budget announcements, there's been a steady increase in access to accelerated depreciation measures for both higher value assets and for an expanded range of entities. These measures were also generally intended to be temporary, with specific sunset dates by which each iteration of measures was supposed to end. Nonetheless, the government has had a history of extending the measures beyond their scheduled expiry, and so it was unsurprising that one of the first stimulus measures the government brought out in response to the pandemic in March and April of last year was to introduce, extend, and expand a number of accelerated depreciation rules. Then, as the pandemic dragged on for presumably longer than what the government had anticipated, they went back to the well in October during the delayed 2020 budget to offer even greater access to these measures. Even before the 2020 changes, anyone who has ever had cause to read through the various accelerated depreciation provisions would attest that they're fragmented and hard to follow. But what we have today, with so much legislative change brought in so quickly and over such a short period of time, is a true Frankenstein's monster, with multiple overlapping concessions whose key criteria turn on concepts that are similar, but not always the same. And so today, we're going to attempt to unravel some of these changes and hopefully put them into more of a manageable and practical framework as we head towards the end of the 2021 financial year. I'm going to be limiting the focus of today's sessions to the application of the rules to FY21, and I'll address the rules relevant to small business entities separate to medium-sized businesses. We'll go through a broad overview of the primary eligibility rules, how the rules apply to improvements to depreciating assets, and the ability and appropriateness of opting out of these rules according to your circumstances. Then finally, I'll talk through some of the practical considerations that apply to all of the measures that we discussed today. As we go through the session, please bear in mind that we will only be focusing on the key issues. The complex and overlapping nature of these provisions mean that there's absolutely no way that we would be able to cover all of the intricacies in each of these rules, and it would be a fool's errand to even try. And that way lies true madness. Therefore, I very much encourage you to speak to your Pitcher Partners representatives to discuss how these rules apply to your specific circumstances. If you have any questions, I encourage you to ask them in the chat box to this live webinar, and I will hopefully be able to address them at the end of the presentation. So without further ado, let's talk about small business entities. Small business entities, or SBEs for short, are entities which carry on business and broadly have an aggregated turnover of less than 10 million. As I alluded to in my introduction earlier, the turnover threshold for SBEs used to be 2 million, but was increased to 10 million from the FY17 income year. Entities that qualify as SBEs have the option of electing to depreciate their assets using a simplified regime that is outlined in Subdivision 328D of the 97 Tax Act. By way of contrast, the general depreciation rules live in Division 40 of the Tax Act, and so you may hear me refer to depreciating assets throughout this session as Div 40 assets. SBEs that elect to use the simplified regime for depreciation are provided with an immediate deduction for certain assets. Meanwhile, all other depreciating assets must be allocated to a general small business pool and depreciated as part of that pool. In this respect, it's important to note that an SBE cannot elect to immediately deduct certain assets without pooling all of its other assets. But the choice to use or to not use the simplified regime can be made in relation to each year that the entity qualifies as an SBE. Therefore, it's very much a possibility that an SBE can elect to use the simplified depreciation regime in year 1, but elect not to use the regime in year 2. If an SBE elects to not use the regime in year 2, any depreciating assets that it acquires in year 2 will be subject to the ordinary depreciation rules in Div 40. However, any assets it owned that have already been allocated to a small business pool must continue to be depreciated as part of that pool. Furthermore, that SBE is ordinarily prohibited from electing back into the simplified depreciation regime for the next 5 income years. However, the recent changes to depreciation have turned off this prohibition for the next few years to enable SBEs the more freedom to elect into and out of the simplified regime during the period that the government is calling the increased access years. Now, we often use shorthand to refer to SBEs as having, aggregated turnover below 10 million. But now, more than ever, it's critical to appreciate that there are actually 3 separate ways in which an entity can satisfy the criteria of having an aggregated turnover below the threshold for the current income year. The first way is where the entity carried on business in the previous income year and its aggregated turnover for the previous year was below 10 million. Accordingly, it's possible that an entity with aggregated turnover well in excess of the threshold in the current year could still qualify as an SBE based on its prior year performance. The second way is where the entity's aggregated turnover, worked out at the start of the current year, is likely to be below the threshold. Therefore, if an entity's budgeted performance at the start of the year indicated that its aggregated turnover was likely to be below 10 million, but it ultimately ended up having a bumper year such that by the end it had well exceeded 10 million, it may still qualify as an SBE. The only exception to this method is where the entity's aggregated turnover for the 2 previous income years had already exceeded the threshold. The final way is the most straightforward one, where the entity's aggregated turnover, worked out at the end of the current income year, is in fact below the $10 million threshold. Now, it's perhaps a little bit trite to state, but important to understand that the entity must itself carry on business in the current year. This is even if it was using last year's aggregated turnover to determine its SBE status. Similarly, it's critical that all connected entities and affiliates are identified so that we can ensure that their respective turnovers are aggregated with the entity that's actually being tested. For SBEs that qualify and elect to use the simplified depreciation regime for FY21, there are 2 eligibility thresholds for an immediate deduction on new assets. When an asset costing less than $150,000 was acquired between 12 May 2015 to 6 October 2020 and first used for a taxable purpose or installed ready for use for a taxable purpose between 12 March 2020 and 30 June 2021, that SBE is entitled to an immediate deduction for the cost of that asset. In practice, in the context of FY21, this would apply to an asset that is first used or installed ready for use for a taxable purpose between 1 July 2020 and 30 June 2021. Had the asset been first used between the period 12 March 2020 and 30 June 2020, any deduction would have been relevant for the FY20 year, not the FY21 year. Alternatively, where an asset was acquired between 7 October 2020 and 30 June 2022 and first used for a taxable purpose or installed ready for use for a taxable purpose between that same period, the SBE is entitled to an immediate deduction for the cost of the asset with no limit on the cost. And so in practice for FY21, this would apply to an asset acquired during this period that is first used already or installed ready for use between 7 October 2020 and 30 June 2021. In addition to acquiring new assets, an SBE might also incur expenditure to make improvements to an existing asset or to relocate an existing asset from one place to another. These costs are generally referred to as second element costs and would ordinarily be required to be capitalised into the cost of the existing asset. This means that if second element costs are incurred in the same year as when the asset was acquired, the cost of the asset for the purposes of assessing that $150,000 threshold must include those second element costs. So if I was to give you a quick example, if during FY21 an SBE acquired an asset for $140,000 and then spent $15,000 calibrating it for use, the cost of the asset would be $155,000 and therefore would actually make the asset fall foul of that $150,000 threshold. But if an asset had previously been eligible for an immediate deduction in an earlier income year under the simplified regime, and second element expenditure was incurred in FY21 during one of the periods that's listed in that middle column there and falls below that relevant cost threshold, then that second element expenditure should also be eligible for an immediate deduction in FY21. So the watch out here for second element costs is the timing of when they're incurred and also which assets they have actually been incurred in respect of. If the SBE qualifies for an immediate deduction of a number of assets, there's currently no ability to opt out of the measures on an asset-by-asset basis. Your only avenue here would be to elect to not apply the simplified depreciation regime for FY21, in which case there would be no immediate deduction for any assets available. So as I mentioned earlier, if an SBE chooses to apply the simplified depreciation regime to get access to the immediate deduction for assets, it must also comply with the SBE pooling requirements. In the first income year in which an SBE elects to use the simplified depreciation regime, you must allocate the taxable purpose portion of all your depreciating assets to the small business general pool. This would give you the opening pool balance going forward and also for the current income year. Under the ordinary rules, the SBE pool rules enable you to deduct 15% of additions to the pool made in each year and will also give you 30% deduction for the opening pool balance. However, accelerated depreciation rules have also been implemented in respect of the SBE pools, such that in FY21 and FY22, SBEs would be entitled to a deduction for the opening balance of their SBE pool without a cost limit. Furthermore, all additions made to the SBE pool can also be immediately deducted without a cost limit. So in effect of all of this, if you are an SBE and chose to use the simplified depreciation regime for the first time during FY21, you would be entitled to a full deduction for all your existing depreciating assets on hand. This could obviously be a very favourable outcome for some entities. This is also in contrast with FY20, whereby there was a limit of $150,000 to the deduction, albeit certain assets added to the pool during FY20 were able to be depreciated at a higher 57.5% rate rather than the standard 15%. For FY21, the interaction between the SBE pool rules and the immediate deduction rules can also create a bit of an anomaly, which I'll illustrate by way of an example a little later on. Similar to the immediate deduction rules, there's no opt-out of the application of this provision if you satisfy the criteria. Again, your only avenue would be to elect to not apply the simplified depreciation regime for FY21 at all. But the watch out here is that even if you choose not to apply the simplified depreciation regime for the current year, any assets that have already been allocated to the SBE pool in an early income year will remain subject to these rules for all future years. And therefore, if you had previously elected to use the simplified depreciation regime in an earlier year, such that you already have an SBE pool, you would be required to deduct the full opening balance of that pool in FY21, regardless of whether you chose to apply the simplified depreciation regime or not for FY21. So in speaking about all these rules and deductions, it's worthwhile to bear in mind that certain depreciating assets are actually excluded from the application of the simplified depreciation regime for SBEs. A key exclusion involves an asset that is or might reasonably be expected to be let, predominantly on a depreciating asset lease, whereby the owner of the asset grants another entity a right to use the asset other than under a hire purchase agreement or under a short-term hire agreement. Other exclusions from the simplified depreciation regime include primary production assets, which normally have their own accelerated depreciation rules anyway, and assets that have already been allocated to a low value pool or a software development pool. So with all that out of the way, I thought it might be a good time to go through a bit of an example so that we can see how these rules apply in action. So in this particular example, BizCo has an aggregated turnover of 9 million for FY21 and therefore qualifies as an SBE, and in this particular case, elects to use the simplified depreciation regime for SBEs. On 1 October 2020, BizCo acquired and began using a truck costing $125,000 that has an effective life of 10 years. So when we apply these rules, BizCo acquired that truck pre-6 October 2020 and began using it at the same time. And so because the truck's cost at the end of the year is under $150,000, BizCo should be eligible for a full deduction of the cost of the asset in FY21 under the immediate deduction, under the immediate deduction provisions. And you'll see that there on your screen as $125,000. But what if there was an additional fact in that on the 15th of December 2020, BizCo incurred a further $30,000 on making improvements to the truck? Well, in this case, because the improvements were made to the truck in the same year that the truck was acquired, those costs are required to be included in the cost of the truck when you apply the $150,000 threshold. So when you do this, the total cost of the truck for FY21 becomes $155,000 and so exceeds the $150,000 threshold for assets acquired pre-6 October 2020. Therefore, BizCo is not eligible to deduct the cost of the asset under the immediate deduction provisions in FY21. In the ordinary case, where assets aren't eligible for immediate deduction, as I mentioned, they're required to be allocated to the SBE pool and depreciated in line with pool rules. However, for FY21, any additions to the SBE pool can also be deducted without a cost limit as part of the SBE pool rules. And so, in effect, for FY21, you'll actually get an immediate deduction for the full $155,000 spent on that truck, albeit just not under the immediate deduction provision. So it's a little bit illogical, but funnily enough, that's just how the rules work for FY21. And it's also worth bearing in mind that this is an outcome that did not work or did not apply for FY20. And so this example illustrates why these rules have to be considered very carefully and in relation to specific circumstances. As I mentioned earlier, for each year that an entity qualifies as an SBE, it can choose to use or not to use the simplified depreciation regime for that year. How you fill out your tax return is evidence of your choice. Therefore, if you're an SBE choosing to apply these rules for FY21, please ensure that these boxes in the capital allowances schedule of your FY21 income tax return is completed. Not filling out these boxes may indicate that the SBE has chosen not to use the SBE depreciation regime or the simplified depreciation regime for FY21. And if this is a mistake, there may not be an opportunity to go back to make a different choice. So please be aware of this if you are looking to elect into these rules for FY21. Now let's turn our attention to medium-sized businesses who have access to 3 separate measures for accelerated depreciation for FY21. Instant asset write-off. The instant asset write-off for medium-sized businesses was first introduced for assets that were acquired from 3 April 2019. It was originally intended to provide the same immediate deduction that was available to SBEs, but to entities that had an aggregated turnover of greater than 10 million, but less than 50 million. In March 2020, as part of the first package of COVID-19 stimulus measures, the government increased the cost threshold from $30,000 to $150,000 for assets first used or installed ready for use on or after 12 March 2020. And this would be the same thresholds that actually apply for SBEs. The government, as part of these measures, also enabled businesses with aggregated turnover up to 500 million to also access the instant asset write-off. These measures were actually originally due to end on 30 June 2020, but have been extended to apply to 31 December 2020. And this is why the instant asset write-off applies for FY21, but only for assets that were acquired before 31 December 2020. Having said that, they can actually be first used or installed ready for use at any time up to 30 June 2021, as long as they were acquired before 31 December 2020. For the same reason, the deduction that is available under the instant asset write-off for FY21 would be for the cost of the asset that is measured as at 31 December 2020 for June year-end balances. Now, the instant asset write-off is no longer applicable for assets acquired post 1 July 2021. And before any of you jump up and down and say and point out that I said in my introduction, the government tends not to or tends to extend these measures, let's just hold that thought and we can come back to that. If you satisfy the eligibility criteria for instant asset write-off, there's no ability to opt out on an asset-by-asset basis. And in this respect, it very much mirrors the SBE rules. Lastly, it's important to note that the instant asset write-off is not available to entities with an aggregated turnover below 10 million. Therefore, if you're an SBE that is elected not to apply the simplified depreciation regime for FY21, you will not be able to access the immediate deduction for assets under the instant asset write-off. You may, however, be able to access the other 2 accelerated depreciation measures that we'll discuss in the next few slides. So together with the expanded instant asset write-off rules, the 50% backing business investment or BBI measures were also introduced in the March 2020 package of COVID-19 stimulus measures. The BBI measures were effectively targeted at the same range of entities, those with aggregated annual turnover less than 500 million, but it applied for assets that cost more than 150,000. So in other words, assets that did not actually qualify under the instant asset write-off. The BBI measures also extends for 6 months longer than instant asset write-off and can apply to assets that were acquired up to 30 June 2021, subject to the application of some integrity rules. By contrast, and just as a refresher, the instant asset write-off only applies to assets that were acquired up to 31 December 2020. If you're eligible for the BBI in respect of an asset, the tax depreciation for that asset for the year is calculated as 50% of the asset's cost, plus what you would get under ordinary depreciation rules on the remaining 50% of the asset's cost. And so on that last part of the calculation, you would need to apportion your depreciation deductions based on the number of days that you held the asset during the year. Unlike the instant asset write-off, though, there is an ability to opt out of the application of BBI on an asset-by-asset basis. I also note that SBEs who choose not to apply the simplified depreciation regime are able to access the BBI measures, and that's because it doesn't specifically exclude entities with aggregated turnover less than 10 million. The third accelerated depreciation measure is the temporary full expensing, or TFE for short. Unlike the instant asset write-off and the BBI, the temporary full expensing rules were introduced in October last year as part of the delayed 2020 budget that was handed down on 6 October 2020. The temporary full expensing rules applies to businesses with aggregated turnover under 5 billion, and it applies for assets that are first used or installed ready for use between 6 October 2020 and 30 June 2022 without any cost caps. There isn't a strict acquisition date rule for the temporary full expensing measures, although integrity rules will still apply. Like the BBI measures, there is an ability to opt out of the application of temporary full expensing on an asset-by-asset basis. And also like the BBI, SBEs who choose not to apply the simplified depreciation regime are able to access the temporary full expensing measures. So just as the case with SBEs, it's important to bear in mind that not all assets are eligible for BBI or temporary full expensing. So if we look at backing business investment measures first, any assets that were the subject of pre-12 March 2020 commitments are not eligible for the BBI measures. This would include situations where you may have entered into a contract to buy the asset pre-12 March 2020, or where you started to construct the asset pre-12 March 2020. Now, I also mentioned integrity rules earlier, and these apply in instances like where you had a contract to purchase an asset pre-12 March 2020, but then entered into a separate contract to buy an identical or substantially similar asset after 12 March, and you engaged in that conduct specifically for the purposes of gaining access to the BBI measures. Needless to say, the ATO and Treasury don't take kindly to these sorts of conduct, and so we should try and avoid them completely if possible. Secondly, any assets where amounts were deducted under the instant asset write-off are not eligible for backing business investment. And third, second-hand assets are not eligible for backing business investment measures. In terms of temporary full expensing, the exclusions for the TFE measures are actually a little bit more complex. Second-hand assets and any assets that were the subject of pre-6 October 2020 commitments are not eligible for TFE, but only for entities with aggregated turnover greater than 50 million. A similar integrity rule to the one I outlined for BBI also exists for TFE, but again, only for entities with aggregated turnover above 50 million. And so it would therefore appear that if you're an entity with aggregated turnover under 50 million, you should have access to the temporary full expensing measures for both second-hand assets and for assets that you had already committed to purchasing pre-6 October 2020, provided that you actually acquired it after 6 October 2020. Assets are also not eligible for temporary full expensing if a balancing adjustment event occurs for the asset during the current year. Now, common balancing adjustment events include instances where you sell or scrap the asset, and so in a manner of speaking, this exclusion would appear to be relatively logical. But be aware that balancing adjustment events can occur for a variety of different scenarios, not just the disposal of assets. And so you should take care to make sure that you don't inadvertently fall foul of these rules due to one of the less common balancing adjustment events. In this respect, there's a particular risk for partnerships when new partners enter or exit the partnership during the year. This is because the tax law deems there to be a balancing adjustment event for all depreciating assets of the partnership when these events occur. Finally, there are also some common exclusions from both these measures for assets that are excluded from the application of Div 40, assets that are not used or located in Australia, assets that are not used for the principal purpose of carrying on a business, and assets that are subject to subdivision 40E or 40F, which relate to low value pools, software development pools, and primary production assets. So with 3 separate accelerated depreciation measures, each with different criteria and different dates, it can quickly get quite overwhelming as to which provisions to turn to first. So in this respect, temporary full expensing is specifically stated to apply in priority to all other provisions. This means that for all assets first used or installed ready for use post 6 October 2020, temporary full expensing should be your first port of call. Instant asset write-off effectively applies in priority to BBI. And this is relevant for assets costing less than $150,000 that were acquired before 31 December 2020 and in use by 30 June 2021. This is an effective priority rule rather than an actual priority rule, simply because there is no ability to opt out of the instant asset write-off. And so while assets in this category can technically be subject to the back-end business investment incentive, if you apply BBI, the way that the tax depreciation is calculated under those provisions would mean that you would effectively expense the total cost or get a deduction for the total cost of the asset anyway. Or if you try to opt out of the BBI, then you fall into the instant asset write-off rules and there is no ability to opt out of those. So in short, instant asset write-off will effectively apply in priority to BBI. To reiterate, you can opt out of TFE and BBI on an asset-by-asset basis, but again, there's no ability to opt out of instant asset write-off. Therefore, there's actually a small overlap in the interaction between the temporary full expensing rules and the instant asset write-off rules for 1, assets which cost less than $150,000, 2, assets that were acquired after 6 October 2020, but before 31 December 2020, and which were first used or installed ready for use by 30 June 2021. Assets with these characteristics would qualify for temporary full expensing in FY21, but opting out of the temporary full expensing would mean that the instant asset write-off would apply. Having said all of that, hopefully, or maybe not hopefully, normal rules or normal depreciation rules will apply post 30 June 2022, subject to any further tweaks that the government decides to make between now and that date. And finally, just like for the SBEs, second element costs can also qualify for one or more of these measures. For instant asset write-off, second element costs will only be eligible for instant asset write-off if the original asset was previously written off under the instant asset write-off rules in an earlier income year. Normal eligibility rules for instant asset write-off will apply to second element costs, but it might be more beneficial to consider the temporary full expensing or the BBI measures first. For backing business investment, second element costs will only be eligible for BBI if the asset was eligible for BBI when it was first used, and the second element costs were incurred in the same income year. Second element costs that are incurred in subsequent income years are subject to the ordinary depreciation rules in Div 40. For temporary full expensing, second element costs are eligible for temporary full expensing on all existing or older assets, subject obviously to satisfying the relevant criteria. And finally, just to reiterate, second element costs must be taken into account in the cost of an asset at year end when considering thresholds, or at 31 December 2020 for the purposes of considering the instant asset write-off. So with all that theory down, I thought it would be helpful to go through a few examples to put some of these rules into practice. So in this particular example, BizCo has an aggregated turnover of 12 million for FY20. Now let's assume that BizCo doesn't qualify for SBE in FY21, and therefore it should be a medium-sized business with aggregated turnover more than 10 million, but below 50. On 1 October 2020, BizCo acquired and began using a truck costing $125,000 that had an effective life of 10 years. So if we were to look at instant asset write-off first, that truck was acquired and started to be used before 31 December 2020. The cost for instant asset write-off purposes measured at 31 December 2020 is $125,000, therefore less than $150,000, and therefore that asset or the cost of that asset is eligible for deduction under the instant asset write-off measures. If we look at temporary full expensing, BizCo isn't eligible for temporary full expensing on this asset because it was acquired before 6th of October 2020. And then for BBI, BizCo is technically eligible for BBI as the asset was acquired and first used between 12 March 2020 and 30 June 2021. But because the instant asset write-off effectively takes precedence, there's really no effect of it being eligible for BBI in this respect. But what if we update the example a little bit and include an additional cost? So let's assume that on the 15th of December 2020, BizCo incurred a further $30,000 on making improvements to the truck. So when we look at instant asset write-off now, again, the asset was acquired and started to be used before 31 December 2020. Tick. However, now that the improvements have been added, the total cost of the asset measured as at 31 December 2020 is $155,000 and therefore in excess of the $150,000 threshold. Therefore, with this new fact, BizCo is no longer eligible for instant asset write-off in respect of the costs on this truck. Now, temporary full expensing, there's actually no change in the outcome for temporary full expensing, and that's because, again, the asset was acquired before 6th of October 2020. So now BBI comes into play because, as we said, it's eligible for BBI as it was first used between 12 March 2020 and 30 June 2021. Because the instant asset write-off is no longer applicable, BizCo could opt to apply the BBI. If it does so, it will get 50% of the cost under BBI and no apportionment for the number of days is required on this component. But BizCo will also get a normal depreciation deduction for the remainder of the cost of that asset apportioned based on the number of days. And those are the amounts that you see there under the Division 40 column. So that's for the cost of the asset. What about for that second element cost that we incurred on the 15th of December? Well, because those second element costs were incurred after 6th of October 2020, those second element costs are actually eligible for temporary full expensing. And so you could actually take a full deduction for the $30,000, notwithstanding that the cost of the asset is actually not eligible for temporary full expensing. Alternatively, if you wanted to, you could opt out of temporary full expensing and elect to apply the back in business investment measures instead, since the original asset was depreciated using the BBI measures. So in this particular instance, if you didn't opt out of temporary full expensing, like in this model, total depreciation deductions for FY21 is $101,849. So this is example 2. It looks very similar to example number 1, but let's change one fact. So instead of the asset being acquired on 1 October 2020, let's assume that it was acquired on 1 November 2020. So if we looked at temporary full expensing first, now that the asset is acquired post 6th of October 2020, BizCo is eligible for temporary full expensing and could deduct the full cost of the truck in 2021 under the temporary full expensing measures. But what if we elect out of temporary full expensing? Well, then if we looked at the instant asset write-off, the asset was acquired by BizCo and BizCo started using the asset still before 31 December 2020. And still, when you measure the cost of the asset at 31 December 2020, it's still under $150,000, and therefore BizCo remains eligible for the instant asset write-off for the cost of the asset under these in this particular fact pattern. And again, there's no change to the treatment of BBI because, again, the instant asset write-off applies. So as I mentioned earlier, this is one of those cases where if you tried to opt out of temporary full expensing, you would actually still be required to deduct the full cost of the asset under the instant asset write-off rules. What about when we include our second element costs? Temporary full expensing. So again, asset is acquired post 6th of October. It's eligible for temporary full expensing, and that would actually include the second element costs, given that temporary full expensing has no cost limit. So total deductions under temporary full expensing would be $155,000. So again, what if we opt out? When we look at the instant asset write-off rules, we satisfy all the acquisition date rules, but again, for the same reason as in example 1, the inclusion of the second element costs would take the asset above the $150,000 threshold, and therefore BizCo is not eligible for instant asset write-off for this asset. It is eligible, however, for BBI. And so again, you get 50% of the cost under the BBI, but also your normal depreciation deductions. The difference in this example, however, to example 1, is that the full cost of the asset is subject to BBI, including that second element cost. This is because BizCo is not able to access the temporary full expensing measures for the second element costs because it had opted out of using temporary full expensing in relation to the truck. So once you've opted out, second element costs can no longer be applied. So under this scenario, total deductions for FY21 are approximately $88,000. What these two rules hopefully illustrate is the intricacies of the interactions between these rules and the important role that dates play when assessing the application of these rules for FY21. Moving on to another example, the ability to opt out of the application of the BBI and temporary full expensing measures is something that Pitcher Partners successfully campaigned for with Treasury, and it's something that we feel offers much better flexibility for our clients and for the broader community. And so this example illustrates how the ability to opt out could potentially be utilised and outlines a few considerations that could be relevant when evaluating a decision to opt out. So in this example, assume a business with $40 million aggregated turnover and $600,000 of taxable income prior to applying any depreciation deductions for these new assets. During FY21, the business acquired and first used 6 separate assets. Assets 1 to 3 were acquired and first used on 1 July 2020. So if we look at each of these assets in turn, asset number 1 was acquired, and asset number 1 and asset number 2 were acquired pre-6th October. They were acquired before the relevant dates, but fall under the $150,000 threshold. And therefore, for both these two assets, they are eligible for instant asset write-off. For asset number 3, it cost $200,000 and therefore exceeded the $150K threshold for instant asset write-off. But it's not eligible for temporary full expensing either because it was acquired before 6th of October 2020. And therefore, it is eligible for BBI. And this would give you a $150,000 deduction, a $150,000 deduction, which is calculated as a $100,000 deduction for 50% of the cost, and a further $50,000 deduction under the normal depreciation rules when you apply the remaining cost over the effective life of 4 years. Assets 4 to 6 were acquired and first used on 1 January 2021. And as all of them were acquired and first used post 6 October 2020, all of these assets are eligible for temporary full expensing. So without more, there would be total depreciation deductions in FY21 of $1.2 million and a tax loss of $600,000. So expanding on these facts, assume that the entity in question is a company, BizCo, and BizCo has paid income tax of $75,000 in FY20. Now, BizCo would like to take advantage of the loss carryback rules that were introduced in last year's budget and obtain a refund of the tax that was paid for FY20. To achieve that, BizCo would need to target a tax loss of approximately $288,500 in FY21, which would give it a loss carryback refund equal to the $75,000 tax paid. Under option 1, if you opted out of BBI and TFE rules for asset 6, the normal depreciation for asset number 6 would be approximately $80,000. And so that would give you total depreciation for the year of $880,000 and therefore giving you a tax loss of $280,000. So it won't give you the full loss carryback because we're not quite yet at that $288,000 mark, but it's pretty close. But, if you'd like to try and get it a little bit closer, maybe we could look at another option. What if we opted out of asset number 5 instead? If you opted out of BBI and TFE rules for asset number 5, the normal depreciation on asset 5 is $11,000, and that gives you total depreciation of $936,000 and a tax loss of $336,000. That's enough to give you the full loss carryback and a refund of all FY20 tax paid. But one thing to keep in mind is that asset number 5 has an effective life of 25 years. And so it'll take a long time to depreciate. And whereas contrasting this with option 1, where asset number 6 only has an effective life of 5 years. And so that might be the trade-off that you're looking at. Do you want the full loss carryback, or would you prefer to carry the cost of asset number 5 throughout its 25-year effective life? Opting out for asset number 5 also gives rise to more losses than BizCo actually needs for loss carryback. And so there's a question as to whether that's a desirable outcome in the context of the loss recruitment rules going forward. Lastly, option number 3. What if you tried to opt out of the measures for assets 1, 2, and 3? So in this particular example, bear in mind that instant asset write-off will apply for assets 1 and 2, and so there is no opt-out available for those 2 assets. You can opt out of asset 3, the backing business investment measures, and its normal depreciation is calculated at $100,000. So again, while this option would give you full loss carryback, it results in even more excess losses than option number 2. Moving on, now let's assume that the entity in question is a trust, BizTrust. BizTrust has access to 2 adult beneficiaries with no other sources of income, and therefore BizTrust would like to target a taxable income for FY21 of $180K so that each of the beneficiaries could be taxed on $90,000 each. So as an option, what if we opted out of all possible assets? If we go in order, again, assets number 1 and 2, instant asset write-off applies, so there is no opt-out there. If you opted out of all of the other assets, it will still leave you with normal depreciation for each of those assets as shown on the slide. And if you have a look at that, the total deductions there is $378,500, and the taxable income it will leave you with $221,500 of taxable income. So it's close, but still a little bit over that $180,000 target. Another option might be to opt out of all assets other than asset 5, which has the longest effective life. And if you did this, instant asset write-off will apply to assets 1 and 2, so they are still getting a full deduction. And the benefit of opting out will only apply to assets 3, 4, and 6. Under this scenario, total depreciation deductions will be $642,500. I keep missing the 500, and your tax loss for the year will be $42,500. So there can certainly be a lot more permutations on each of these options than what I've outlined today in this example. But I think it's a helpful illustration that opting out of the BBI or TFE measures can give rise to a range of outcomes that might suit your specific objectives for FY21. So I'd like to finish today by touching on a few of the practical considerations that may be relevant when applying these rules. If you're buying a business and looking to take advantage of these measures, purchase price allocation would be quite critical. The examples we went through today illustrate the potential for different outcomes when assets have different costs or when assets have different amounts allocated to their first element or second element costs. Timing would also be a critical factor in assessing the application of these rules to make sure that you're looking at the right dates for acquisition and to determine when something has started to be used or has been installed ready for use. There are also lots of potential interactions with other areas of tax law. I've listed only a few on this slide, but that's not to say that they are exhaustive. So if we look at the company and trust loss rules, the ability to utilize tax losses in future income years will depend on satisfaction of relevant loss recruitment rules. And so the generation of excess losses in FY21 may mean that more losses could be forfeited if there's a risk that loss recruitment tests won't be satisfied in the future. So this might be a motivating factor to examine your ability to opt out of these measures in a little bit more detail. Loss carryback is something we looked at in the last example, and it's available for companies which generate an FY21 loss and paid income tax in FY19 and or FY20. Careful management of the accelerated depreciation rules may enable you to obtain a refund of tax paid in prior years under the loss carryback rules. On tax consolidation, the way that these accelerated depreciation deductions interact with some of the tax consolidation provisions, particularly for entities joining or leaving a tax consolidated group, is not at all clear. There are also adjustments to be made to the tax cost setting rules where assets of a joining entity have already been fully depreciated under these rules. And so it's definitely something to be aware of and carefully considered if tax consolidation is relevant to you. Third, taking advantage of these rules are very likely to lead to significant accounting tax differences that need to be managed. This is particularly for FY21, where the bulk of the depreciation deductions will come through, but it also applies potentially in future years when the immediate deductions actually start to unwind. So this creates a bit of a watch out for tax planning in FY21, and that's because some businesses may not have all the depreciation information necessary to quantify the impact of these rules by 30 June. This is particularly problematic for the instant asset write-off where there is no opt-out function. And so it might be worthwhile now to start reviewing any new assets that were acquired up to 31 December 2020 to determine whether they would qualify for instant asset write-off. At least with BBI and TFE, you should have until at least the lodgement of the 2021 tax return to determine whether you'd like to opt out for those specific assets. Unit trust is another one. Accelerated depreciation measures have always been problematic to manage for unit trusts. And so please be aware of unit trustees which don't use taxable income as their definition of trust law income. This can give rise to potential issues in respect of CGT event E4, where the quantum of the trust or accounting distributions for FY21 exceeds the taxable income distribution for FY21. There's also a potential impact on the ability of companies to frank dividends, where the application of these rules may mean that a company with surplus retained earnings is not able to pay fully franked dividends due to the reduced amount of tax payable as a result of these measures. And lastly, just something to keep in mind, assets will have significantly lower tax cost, if not a nil tax cost, after applying these accelerated depreciation provisions. And so there is the potential for clawback when the assets are eventually sold. So hopefully what we've covered today helps to put the recent changes to tax depreciation into a more manageable and practical framework for the 2021 financial year. I hope you found it useful. But if nothing else, today's presentation should illustrate how complex some of these rules are, particularly where there is potential for overlap between different measures and why careful consideration of these measures is required. As I said earlier, there are a lot of intricacies that we didn't cover today, and the devil is unfortunately always in the details. So I highly encourage you to speak with your Pitcher Partners representative to ensure that we're considering your specific circumstances as we work through these rules. And now, let's see if we can have some questions. So if you just bear with me, I've got 3 minutes left. I promise I won't keep you any longer than that. I've got a question that says, do the rules apply to a business which first commences in FY21? Yes, the rules can apply as long as you carry on business in FY21. Second question asks, which rules allow for an asset by asset choice? So that would be the temporary full expensing rules and the backing business investment rules, if we're not talking about FBEs. Here are my contact details in case you do have any questions directly for me. Thank you very much for your attendance and your attention today, and hope you have a great rest of the afternoon.